Monetary tightening is broadening out across the developed markets. In many ways, this is positive. It shows the wounds are healing after the global financial crisis. But there is some need for caution. It's a big change from the ever-looser policy of the past decade. North America is leading the way, no longer just the United States. Canada raised rates twice in the third quarter, and there's more to come. But the United States still dominates. Not just a story of rate hikes. Balance sheet is going to start shrinking from October, and overall G3 central bank balance sheets will peak in about a year's time. The Fed says we can expect 4 more rate hikes by the end of next year. That looks about right to us. I think they're not too worried about the slower inflation readings we've seen in recent months, because in the end, low unemployment is effective and it will drive prices higher. Elsewhere, ECB is responding to the positive economic data. It will soon announce plans to taper asset purchases, and they'll stop increasing the balance sheet by around the middle of 2018. We could see a rate hike by the end of next year, along with Switzerland. England looks like they're not far behind, but they do seem confused whether they should be focused on weaker growth or higher inflation. And with Australia and Sweden only about 6 months away from a rate hike, that just leaves Japan left as the last big economy still to tighten policy. We need to think about how this relates to the debt buildup we saw post-global financial crisis. This largely takes 2 forms. More government debt in the developed markets. Private sector debt actually is lower, but the government debt is long maturity, and tightening shouldn't be a big problem. In emerging markets, debt's gone up, but that's mainly in China. This has the potential to be a big problem at some point, but it's a domestic problem, and closed capital account means they're not too sensitive to G10 tightening. So we think not too many risks to global economic growth from a gradual withdrawal of monetary support. It just reflects better economic conditions, but maybe there are some risks to financial markets after a decade of ever looser policies.
We begin this month with a note of caution. We reiterate our call to warn against some of the very optimistic valuations in the high-yield market. So far this year, new issuance has been on record-breaking form. It is still very easy for the large majority of corporate issuers in both emerging and developed markets to issue bonds into the market at very low yields compared to historical levels. Our sense is that there are some companies that have very strong balance sheets and offer very good value, but at the same time it is becoming gradually more and more difficult to just find these firms. It seems quite clear that both sentiment and liquidity remains very, very supportive, despite the fact that credit spreads are now tighter, meaning that there is less risk premium on offer for the investor than the period immediately preceding the Lehman crisis in 2008. Our advice is to keep rotating away from the lower credits and into higher rated issuers. Equity markets were quiet for the most part of the last month and then surged towards the end of the month, especially European equities. They were the beneficiary of a weakening euro, as well as some comforting news and developments on the political front. Asian and US stocks lagged behind for the rest of the month. Of note for the next month will be how markets react to the gradual moves by the Fed to begin the reduction of its balance sheet by selling some assets, reducing assets, as well as the response to the much-hyped tax reform plan of President Trump. We are very skeptical of its real impact, with some estimates putting up to 80% of the gains in the hands of the top 1% of income earners, and this based on the relatively sparse details available at present. If correct, this will reduce its implementability as well as its overall market impact. In the short term, though, market sentiment may be buoyed.